Hello, everyone. Welcome to Feedstuffs 365. I'm Sarah Muirhead. In the last few weeks, we've heard a lot about the banking situation with the collapse of several banks, the mergers of a couple other major banks in the industry. We've got interest rates that are in the news. Here today to share his thoughts on the banking industry woes, along with providing an outlook on the overall profitability in the livestock sector, is Richard Brock of Brock Associates. Welcome, Richard. Great to have you with us again.
Good afternoon, everyone. Always fun to be here.
So for those of you that are joining us online, a reminder to post your questions there in the right-hand side of the screen in the chat. If you're joining us through our social media feeds as part of Facebook, Twitter, or LinkedIn, be sure to just post your questions right there in those feeds, and we will get those on to Richard. So Richard, I know you have some slides, so let's get those up for you, and then the floor is all yours.
All right. Thanks, Sarah. And good to be back with everyone again. I assume some of you were with me a couple of weeks ago down at the AFIA conference in Orlando, Florida. That was a very good meeting, and they had a great crowd. But a lot has happened in 2 weeks' time. I mean, it's really incredible how much has happened. So I always have to show a disclaimer since we're a registered advisor. There's always a risk of losses as well as profits when trading futures and options. I'll start out with this was a page I just copied out of the New York Times Sunday edition to show you four of the banks that have got issues. And it graphically is a good representation of what's going on. You'll see the Silicon Valley Bank, which is now gone, and the amount of losses that they've incurred in the last actually the last few months. And then you have Signature Bank here that has also gone out of New York City. But the thing about these banks, and a lot of this has been related to cryptocurrency as well. I mean, the one that hasn't been talked about, there was a bank that on March 1st shut down in San Diego named Silvergate Bank, and that was basically a crypto bank. And so, just some of these banks do some risky investing, and that's basically what has happened here. The other thing that is important to understand, and I'm no expert on banking at all, but some of this is, I think, pretty important to understand. And if banks bring in deposits, and when this big one in Silicon Valley went down, they were going through huge growth, and almost all their lending is in high tech companies, and some of them are very large. But when they bring the money in, they invest it normally in two different types of securities, and they're classified as either held to maturity securities, which, for example, in this case, where they were buying 20-year bonds, you couldn't mark them down without showing the losses. Available for sale securities, which are securities, short-term bonds, they can get out of and liquidate right away. And the reason they were doing this is, if you go back a couple of years ago when rates were really low, before the Fed started raising interest rates, short-term rates were much cheaper than long-term rates. And long-term rates at that time, you could buy 20-year bonds that were paying about 1 3/4 points, 1.75 basis points or interest, whereas they were getting nothing near term. And so as this money was coming in to try and generate income, they were buying them out. And you say, well, why would anybody lock in that low of a rate that long term? Well, 2020 hindsight, we can all recognize it's not a very good maneuver, because you're locked in then to a low rate for a long time. And so then the paper losses were just killing them and took them to a negative net worth. And then the Fed came in and closed them down. But the reality is, I don't think you're going to find a lot of other banks in that situation. So first of all, this is not at all like 2008. That was caused basically by the housing crisis and destroyed the mortgage business, and that took some banks down on mortgages. This crisis is fueled primarily by banks that invested in bond securities near the bottom of the interest rate cycle. Then, as the interest rates went up, of course, bond prices went down, and everybody can, with 2020 hindsight, we can all see it was a very bad decision. In the case of Silicon Valley Bank, it was the 16th largest bank in the United States. when it was taken over by federal regulators on March 10th. So this is not very long ago. It was the second largest bank failure in U.S. history. From 2019 to the end of 22, for example, Silicon Valley's bank's bond holdings designated as available for sale went from 14 to 27 billion. This is how fast the bank was growing. But their held to maturity went from 14 to 99 billion. Just they put way too much money into those long-term bonds, and now, of course, paid the price. Rising interest rates resulted in roughly a $23 billion loss in the value of their bond holdings, and would have resulted in a negative net worth to the bank if they had been held to maturity or if they were marked to fair market value. After Silicon Valley was unable to raise additional capital, big uninsured investors came in and started making huge withdrawals. Once the news got out they were in trouble, everybody raced for the door, and like it says, there's a good old-fashioned bank run, and it didn't take but a few hours to close the place down. The collapse of Signature Bank, coming just 2 days after the collapse of Silicon Valley, was the third largest bank failure in U.S. history, and with the events somewhat similar to those at Silicon Valley, but not nearly as dramatic. So the government, the Feds came in and took over those, and of course, as you all know, I mean, what's very controversial right now is, should they have come in and bailed everybody out? And of course, some people are saying this was political because particularly in the case of Silicon Valley, you had a bunch of billionaires with money in that bank, and they, all are very tied in politically, and so, who's to say whether or not this will happen again? But it is very controversial. Yellen was speaking at the American Bankers Association this morning, and I just read a copy of her speech, and essentially she did not give any guarantees that they would do that again. And right now, my guess is they won't, but they wanted to stop a run on other banks. Then Credit Suisse comes along, headquartered in Switzerland, is one of only 30 financial institutions globally that are designated as too big to fail. And so they have been given a cushion. They should be okay. Theirs is mostly just due to a lot of bad loans over the last 10 years. And to prevent a catastrophic bank failure from occurring, the 167-year-old Swiss bank was taken over, and the Swiss government and UBS came in, took over a lot of the debt, and Swiss National Bank. First Republic, next on the list, headquartered in New York, had similar issues, almost all tied to long-term bonds. As of Monday, yesterday, and as this morning, they're still in operation. The good news here is almost all ag lenders are more conservative. There are absolutely no rumors on the street that any of the ag lending banks are having any difficulty at all. I think they're all very solid. I would anticipate the ag lenders will, however, become more risk adverse as a result of this publicity. And I think they're going to keep their spreads fairly high. I would not be looking for any favors from any banks now that I was trying to get a loan for. I mean, they're going to keep their spreads as high as they can. I want to cover a couple other things, though, that I think are very important right now. And for those of you who were at the AFI meeting 2 weeks ago, I showed this slide, and everybody hears everybody talking about the inverse on our yields, i.e. short-term rates are higher than long-term rates. Now, we'll know more about this tomorrow. The Fed is meeting today, and they will come out with their announcement tomorrow whether or not they're going to raise rates again. The bets on the street right now in early trading looks like we will get a quarter of a point bump tomorrow, and then that would take short-term rates, I think, back up above 5% on T-bills. So we're seeing a lot of money rolling into T-bills right now. What this chart shows, though, is when we've had inverted yield curves in the past, and you can see where all the arrows are, what has happened, and I'm not saying it's going to happen again, but it's always thrown us into a recession. If you go back to the last one here in 2008 and 9, the yield curve went inverted about a year before the official recession was announced. Same thing happened back here in 2002. And here's where we're at right now. And at least in my opinion, I think it's inevitable that we're going in to a recession. And you take a look at all the layoffs in Silicon Valley right now, too. I mean, it's just going to have a trickle-down effect, I'm afraid. This is also interesting. The flight when all this news started on the banks. Okay, here's the 1st of March right here. You can see money started flowing into gold. This is a April gold futures chart about a half an hour ago, and the market kept going up sharply. And then today we are down sharply, and which is an indication that investors now think that this scare is over and that the worst is behind us on the bank failures. Some of you who follow us a lot know, too, we like technical analysis. And I just want to point out that this is a 1, 2, 3, 4, 5 wave down. Today's a 5-way sell signal. So if you were a trader of gold, this would be a day to be selling it, not buying it. Okay, other related concerns. This is one of my biggest concerns, and it has not been getting a lot of publicity lately. But I am, and I think a lot of people in the industry are starting to get concerned about the profits of the pork and beef, because these companies, all the big producers, are very large borrowers. And this was a great deal up until 2 years ago, as long as rates kept going down. But now all of a sudden rates are going up. They've more than doubled. And so you take a look at cost of operating a large cattle operation or pork operation right now. Their interest rates are much more than they used to be. The industry, again, they haven't had to deal with this for at least 30 years. A quick spike like just occurred in the last year and a half has negative impacts on bottom lines. As you will see in the chart I'm about ready to show you, pork producers right now probably looking at the worst financial year they've had since 2012, and most of this has happened like real recently, as recent as last July. Average pork producer in Iowa is making $40 a head, and now they're losing over $40 a head. First it was because of the high grain prices. They've softened a lot in the last 3 weeks, but that hasn't really hit the bottom line yet. But doubling interest rates from a year ago is hurting. I don't know. It could well lead to some more consolidation in the pork industry. It's going to take a while for the industry to sort this out. This is a chart put together by Iowa State, and it goes back to 1990. And you see here's the very profitable year back in 2015 when the industry was making over $80 a head profit. And here we were just less than a year ago making $40 and now losing 40. And I think this is actually worse than what this chart shows, because the data behind this that Iowa State put together, they're not raising the interest rates hardly at all. They're using essentially the same cost per head for interest as they were a year ago. They've increased it about 10% from a year ago, and that's not going to be enough. So this is getting pretty ugly. Feed costs are going to be coming down more, in my opinion, but this is not. This is a scary chart, and I think if I was an ag lender, I'd be a little bit concerned about this right now. As you see, most of the times when we go into this loss, it doesn't last for a long period of time. This is by quarter, but this one just got started 2 quarters ago, and it's again, it speaks for itself. This Friday is going to be a really important report. It'll be the USDA's first estimate for their planting intentions report. At the USDA Ag Outlook Forum, they forecast 91 million acres. Okay, so these are put together by 2 different groups, so there's no reason to think that Friday's report is going to match this one, although we think it'll be pretty close. We're at 90 and a half. A year ago, we planted 88.6 million acres of corn. Go on to the bottom line here. Feed usage for this coming year, i.e., mostly to feed pigs and chickens, up to 5.6 from this year's 5.25. So the numbers are up. Corn for ethanol is flat at about 5.25. Exports are down sharply this year, 1.85. And last year were 2.47. Year before that, 2.74. This will be the first year in history that Brazil will export more corn than the U.S. will export. Bottom line is, though, the stocks to usage ratio this year at 10%. We think next year will be 11.3. The government's at 13%. On a scatter diagram, this would forecast an average price of corn down around $5 a bushel. And even the USDA is at 5.60, and I think they're going to be lowering that. So, everything now depends on getting the corn crop planted. Planting progress right now is up to about Memphis. Louisiana is pretty well planted, and getting up into Tennessee, and they'll make a lot of progress in the next couple of weeks. I show this slide too that shows the correlation between nitrogen and corn prices. It goes back to 1995. It's not always perfectly correlated, but they normally move in the same direction. And since the third week of December, nitrogen and anhydrous ammonia prices have declined by over 30%. And it's our opinion that it's going to continue to follow the corn market and work slightly lower. China's in the news a lot. This is exports for this year. They bought some more corn this morning, but it was a really small amount. But here's where we were in 2021 when they were really buying a lot of corn. This is the season, as you can see, when they normally buy corn, March to mid-April. And so they are back buying some, but we aren't even close to 21, 22, and a long way away from 2021. Their purchases are slightly higher than where they were in 2019-20 marking year, but they're not going to be able to ship enough corn to get back to where we were last year or the year before. And here's a corn chart up to date through yesterday. As one can tell, the major trend is down. And, we feel that the long-term cycle in corn prices has turned and will be lower here for the next several months. And as everyone knows, I mean, everything is a function of getting this crop in the ground and getting it to grow. And then the other thing is important if you look at the 6 of the key states that would include Indiana, Illinois, Iowa, Minnesota, Nebraska, and I'm going to throw South Dakota in there too, because so much livestock feeding in that area. For the first time in history, basis levels are stronger in the Western Corn Belt than they are even in the state of New York. I've never seen that before. And most of that is due those 6 key states. Their peak production was in 2016. We have not come close to peak production in the key livestock feeding states since that year, 2016. And so, we've seen tremendous growth in livestock industry in that area. We've seen steady demand increases in the ethanol side. Poultry industries expanded rapidly in that area, particularly eastern Nebraska, and yet our total production has not gone up. And that is just basically due to weather issues. Last year, it was the wind in Nebraska that wiped out York County, biggest corn producing county in the state. Year before that was a drought in Iowa. Every year there seems to be a major production issue in one of the key states. So this is an important year, and if we do have a good production year and exceed 2016, then you're going to be looking at some significantly lower corn prices. Just a couple comments on soybeans. USDA in their Ag Outlook form is forecasting 87.5 million acres, same as this year was planted last year. We're at 87.8, so we're going to be close. I mean, we might be slightly higher in bean acres. Right now, the profitability is better for beans, but with fertilizer prices coming down, farmers, for the most part, if they're comparing corn to beans, they prefer to grow corn. We are going to see some increases in production in the South. We're going to see cotton acres down, I think, a fair amount, and that will be replaced primarily with corn. This is a November soybean chart. And again, so much has happened in the last 2 weeks. I mean, soybeans have gone from a month ago at $14 to right now they're under $13. This is the lowest price we've been since last summer, July. So it is changing quickly. And, what concerns me with our surveys in December and January, a farmer showed that there were the smallest amounts of corn and new crop corn soybeans forecast or priced as of that time that we have ever seen in history. It hasn't paid in the last 2 years to do forward sell. And so that's what they've learned and that's what they're doing. So I think there'll be a big separation in the P&Ls of a lot of grain producers this year as well. Those who are heavily sold are going to be in good shape. I mean, we came in this week, we're 70% priced on new crop beans. We took profits on 10% of the hedges yesterday, and we're 45% priced in new crop corn. We have no old crop left for the producers we represent. And I think that's going to give them a pretty good year. Here's soybean meal, major sell signal just 2 weeks ago. This is a market that we're recommending our livestock feeders to not buy forward, not to be aggressive. The trend has turned, and I think we'll see meal prices within the next 6 weeks under $440 a ton. Right now, we're about $460. Soybean oil is just, again, extremely volatile. It was up yesterday, down sharply today. I'll show this chart too, and all this shows is that whenever soybeans have gone to an $8.50 premium over corn and nearby futures, that's what these shaded areas are, and showing the results. I'm not saying for sure that'll happen again, but every time we've gone to that much premium, it's resulted in a major bear market in the soybean complex. And we actually think that is happening. It's already started. And here's my concern in the hogs. You can see in the last week, this is June hog futures. This has been an ugly 2 weeks. We've got June hogs have gone from $106 just 3 weeks ago down to $90 today. That's a pretty big hit on the income side for a pork producer. Cattle have gone through the same thing, although they were higher this morning. But all of this is acting like a market, an economy that's getting ready to go into a recession, and the meats are getting hit first. Now, I would say in the next 2 weeks, we should see corrections in both of these markets, both cattle and in hogs. But right now, this is a pretty concerning market because the overall trend has turned down. So with that, here's my contact information. If anybody wants any more news from me or has any specific questions, my email is right there, and phone number, and feel free to give me a call. Do we have any questions that have come in, Sarah?
So yeah, post your questions if you have any here for Richard. In the meantime, we'll get to a few that I have. So Richard, you mentioned recession. I mean, how severe do you think it might be? Will it might be a mild recession? Something that's really going to hit hard. What's kind of just your insight on that, please?
Well, I don't think it's going to be real severe. And I don't think it's going to have any impact to hardly any of us that are on this call right now. Agriculture is pretty much recession proof. It could, as I hinted, might hurt retail price of meats a little bit, but it should be very marginal. I mean, where it's going to be felt most is in the housing market and the job market. And so, and again, and I think the stock market will be immune to it as well. If you look at the long-term cycles in the stock market, I think it's in the process of making a bottom right now. You buy a market when the news doesn't look good, and you look what we've just gone through with this scare in banks, and yet the stock market is performing quite well this week. So I think there's some good signs on the financial side.
What's it going to take to bring some calm to that financial sector, to get lenders to feel like, okay, maybe everything's kind of, evened out here, and we want to be a little more, favorable to lending our funds?
On the agriculture side, I don't think we need to do anything. I think this ship is very steady right now, and it's going to be a very good year on the ag lending side, and even on the non-ag. most of the news out there shows that not many banks were as aggressive at buying long-term bonds as Silicon Valley Bank was. And so, there's bound to be another bank here or there that's going to have some troubles. But I really do think this was a flash in the pan, and the government probably did the right thing, bailing those two banks out, and that gives a little bit of comfort. And it'll be interesting to see what the Fed does tomorrow. Again, the bet's on the street is that they'll raise it a quarter of a point. And I think that'd be good. And I think for the long-term health of the economy, if we could keep rates in this 4 to 6% range, or maybe even 7, that would be better than having much higher rates and better than having rates like we had 2 years ago. We need some stability in that market, and I think it'll find itself around the 6% key interest rate level.
Do you think because agriculture tends to be more conservative and maybe even a safer place to invest, do you think you'll see some non-ag, traditionally non-ag money maybe flow more into agriculture and make it more of it, so funding would be more available to those in ag that want to to borrow?
Well, we have seen a lot of non-ag money funnel in the last 2 years, and that's really helped drive the farmland market to a much higher level than anyone expected. And then we had a lot of 1031 sales that also helped drive farmland prices higher. I think that's going to cool off. Everybody hears the rumors of how much land Bill Gates has bought, which is true. The Gates Foundation has purchased a lot of land over the last 10 years. The Chinese, that's a different argument. I don't think they're really into buying farmland to farm it. Most of the land they bought they're all located around strategic military areas of the United States. So, there's money flowing everywhere, and there's a lot of money looking for homes, but I just think that's going to stabilize right now. The volatility that we see in all markets, normally that results in people not making as big of a change. And let's take a few deep breaths and see what happens here before we do anything else. And so, I just don't think we're going to be impacted negatively at all by that.
Any change do you see in investing in the ag tech sector? Being as the Silicon Valley Bank was very tech, intense in terms of its investments. Do you think any of these investors are going to back off on the ag tech side of things?
I think that is going to slow down appreciably. A lot of companies have come in and invested a lot of money in new tech devices, whether it be in grain production or livestock production. And most of them were given it a window for about another year and a half. But, particularly on the grain side, I think we're going to see farmer spending drop quite a bit now on new high-tech equipment as a result of the drop in corn and soybean prices. This scares people when corn and soybean prices have come down as much as they have in the last 2 weeks. And so I think all of a sudden, particularly since farmers haven't forward sold hardly any grain, they're going to take a deep breath and probably cut back their spending on the high-tech side. So that'd be one that would concern me right now. And Silicon Valley, there's only one ag company that I know of that was involved in that, had a lot of money in there. And I can't mention who that was, but it's now they're going to be made whole anyway. So there's not a lot of concern there.
Very good. So a busy week. A busy couple of weeks since we were in Florida at PISC, and now we've got, this is a busy week with some reports to watch and things going on. As always, you can follow along on the Brock Report. Richard gave you some of that information there on his slide. You can contact him to get more information on that as well. Thank you so much, Richard, for joining us today. Appreciate your insight.
Thank you, Sarah.
It's Richard Brock of Brock Associates. You can find Richard's column also on this topic. It was in the March edition of Feedstuffs, and we did post that there in the chat if you'd like to check that out. You also can go back at any time and watch our archive of Feedstuffs 365 sessions. So if you need to, didn't catch all of this, or you want to share this with a colleague, you can certainly go into feedstuffs365.com. Mark your calendar tomorrow. We're going to be talking to Mike Steenhoek, Executive Director of the Soy Transportation Coalition. He's going to talk with us about the transportation and export markets and what's going on there. Among other things, we'll also be talking to Mike about the recent rail mergers and what they might mean for agriculture. Until then, for Feedstuffs 365, I'm Sarah Muirhead.